Trading in a secular bull market during a cyclical bear market. Financial markets often feel contradictory, and nowhere is this more evident than when traders face a secular bull market operating alongside a cyclical bear market. At first glance, this seems confusing. How can the market be both bullish and bearish at the same time? The answer lies in time frames. A secular bull market refers to a long-term upward trend that can last for years or even decades, while a cyclical bear market represents shorter-term downturns within that broader uptrend. For traders, this environment presents both opportunity and risk. The long-term trajectory suggests growth, but the short-term volatility can punish those who are not prepared. Understanding how to navigate this duality is essential for consistent profitability. A secular bull market is characterized by sustained long-term growth, often driven by strong economic fundamentals, innovation, and expanding corporate earnings. These periods can last 10 to 20 years and are typically marked by higher highs and higher lows over extended timeframes. However, even within these long upward trends, markets do not move in a straight line. Corrections and downturns are natural, and this is where cyclical bear markets emerge. A cyclical bear market occurs within a longer-term trend and usually lasts from several months to a couple of years. These downturns are often triggered by economic slowdowns, tightening monetary policy, or external shocks. During these periods, prices decline, sentiment turns negative, and volatility increases. For short-term traders, this can feel like a full-blown bear market, even though the broader trend remains bullish. Trading in this mixed environment is difficult because signals can conflict. Long-term indicators may suggest buying opportunities, while short-term price action points to further downside. This creates uncertainty, leading many traders to make emotional decisions. The key challenge is aligning strategy with time frame. Traders who fail to distinguish between secular and cyclical trends often enter positions at the wrong time, either buying too early during a downturn or selling too late during a recovery. To succeed, traders must adopt a flexible mindset. Instead of viewing the market as strictly bullish or bearish, it's more effective to think in terms of layers of trends. This means recognizing that short-term weakness does not necessarily invalidate long-term strength. A successful trader embraces this complexity and avoids rigid thinking. They understand that opportunities exist on both the long and short side, depending on timing and context. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 20% off your next purchase. One of the most effective ways to stay profitable is by aligning trades with specific timeframes. Long-term investors may continue accumulating positions during a cyclical downturn, while short-term traders can capitalize on declining prices. For example, swing traders might focus on short positions during bearish phases, taking advantage of downward momentum. Meanwhile, position traders may look for discounted entry points in fundamentally strong assets. This dual approach allows traders to maximize opportunities without contradicting the broader trend. Technical analysis becomes especially valuable in this environment. Indicators such as moving averages, support and resistance levels, and momentum oscillators help traders identify entry and exit points. During a cyclical bear market, prices often break below key support levels, creating short-term selling opportunities. However, as the broader secular trend remains intact, these declines can eventually form strong bases for future rallies. Traders who can interpret these signals effectively gain a significant edge. Volatility increases during cyclical downturns, making risk management more important than ever. Without proper controls, even experienced traders can suffer significant losses. Position sizing, stop-loss orders, and disciplined execution are critical. Traders should avoid over-leveraging and remain prepared for sudden market reversals. Protecting capital during downturns ensures that traders are in a strong position to benefit when the market resumes its long-term upward trajectory. Not all trades are equal, especially in a mixed market environment. The best opportunities often arise when short-term weakness aligns with long-term strength. For instance, sharp pullbacks in fundamentally strong assets can provide attractive entry points. These setups offer favorable risk-to-reward ratios, as the downside may be limited while the upside potential remains significant. Patience is key. Waiting for high-probability setups can make the difference between consistent profitability and repeated losses. Market sentiment plays a powerful role during cyclical bear markets. Fear and uncertainty can drive prices lower than fundamentals justify, creating opportunities for disciplined traders. Understanding sentiment indicators, such as volatility indexes or investor surveys, can provide valuable insights. When fear reaches extreme levels, it often signals that the market is in a turning point. Traders who remain objective and avoid emotional reactions are better positioned to capitalize on these shifts. In a secular bull market with cyclical downturns, traders can benefit from employing both long and short strategies. Short selling during declines allows traders to profit from downward movements, while maintaining a bullish bias for the long term. This balanced approach helps smooth returns and reduces reliance on a single market direction. It also encourages adaptability, which is essential in dynamic market conditions. History shows that markets move in cycles, and understanding these patterns can provide valuable context. Secular bull markets have always included multiple cyclical bear phases, each presenting unique challenges and opportunities. By studying past cycles, traders can develop a deeper understanding of market behavior and improve their decision-making process. This knowledge builds confidence and helps reduce uncertainty during volatile periods. Consistency is one of the most important traits of successful traders. In a complex market environment, it's easy to become reactive and deviate from a proven strategy. Maintaining discipline means sticking to a well-defined plan, even when conditions become challenging. This includes following risk management rules, respecting technical signals, and avoiding impulsive decisions. Over time, disciplined execution leads to more reliable results. Conclusion: trading in a secular bull market while navigating a cyclical bear market is both challenging and rewarding. The key to profitability lies in understanding the relationship between long-term trends and short-term movements. By aligning strategies with specific timeframes, using technical analysis effectively, and maintaining strict risk management, traders can turn volatility into opportunity. Rather than fearing market downturns, successful traders learn to embrace them as part of the natural cycle. With the right mindset and approach, it is entirely possible to remain profitable, even when the market appears to be moving in conflicting directions. Thank you for watching.